This is Josh Jelinski, the financial quarterback. Don't touch that dial. This is Josh Jelinski. Tariffs, Tech, and Turmoil with William Cohan, best-selling author. I want to hear about all your previous books, but the newest book most excites me just because it's Apollo Unbound about Leon Black and the Wall Street powerhouse. So are you allowed to share, because the book's going to be published next year, are you allowed to share a little bit of what you're learning?
I can talk about it. I'm happy to talk about it.
So what's the angle of Apollo Unbound?
Well, all my books tend to be, histories of the firms involved. So this is, a character study of the people who founded the firm and, history of the firm. All three of these guys, everybody sort of worked at Drexel, Burnham before it blew up. Then they founded Apollo after that. So it's been 35 years since they founded the firm. And so, there's a lot of colorful characters. They've done a lot of clever deals. And there's sort of a big succession battle, which is sort of interesting too. So, and a twist of Jeffrey Epstein.
So Apollo Unbound, whenever it's available on pre-order, I want to get it. I'm curious. So this has nothing to do with Epstein. Everybody wants to know. I mean, I want to know. What did Leon have to, all these people with Epstein on the Epstein list, I want to know, were they there because it was a business dealing? Who was the scumbag? Who wasn't? All of those various things. But I guess that'll be for next year. However, Apollo was involved in purchasing Athene. Are you familiar with this? And Apollo's interested in Athene.
They actually started Athene. It wasn't something that they purchased.
Well, no, Athene then bought Aviva, which was a venerable long time. Yeah, but go ahead.
That's right. After Apollo started Athene, then it went on an acquisition spree and bought a lot of, after the 2008 financial crisis, a lot of insurance companies with annuity businesses, were looking to divest them, and Apollo scooped them up, including Aviva, and just kept, getting bigger and bigger and more successful all the time. And, eventually went public company, IPO, with Apollo owning a lot of it. And then when Mark Rowan became the CEO of Apollo in 2021, he quickly announced an $11 billion deal to buy Athene, the rest of Athene that they didn't own. And essentially, Apollo and Athene are one now.
Barry Dyke, who's a friend of mine, wrote the book Pirates of Manhattan, all these interesting exposés, if you're familiar with them. He's really worried about Athene and other insurance companies that are owned by private equity. Do you believe that's a systemic risk when millions of retirees depend on these companies for retirement income in the form of pensions or annuities?
That's a very good question. And I would say before, the market gyrations of the last week or so, I think many people considered it sort of a golden age of annuity insurance businesses. And a lot of them now are owned by private equity firms. I mean, I think probably Athene is better off being owned by Apollo in total. If you're an annuity holder of Athene, you're probably better off with the fact that it's part of Apollo, because Apollo is a bigger and stronger company than Athene was on its own. Apollo is sort of filled with smart people who know how to invest wisely. The assets that are generated by the people who buy the annuities, the cash that comes in to Athene and then is invested. So basically, they're in the spread business, where they, I don't know what the numbers are exactly, but if they owe an annuity holder 4% a year, they then invest that money and hopefully they get 10% or some number. And then the difference between the 10 and the 4 is the 6 is their profit. And as long as they earn more on the assets than they owe on the liabilities, they're going to be happy. The annuity holder is going to be happy. In terms of systemic risk, again, I'd say people feel we're kind of in a golden age with regard to this business because the liabilities and the assets, the duration are matched. Banks get into trouble because their assets and liabilities have different durations. Silicon Valley Bank, you'll recall, went down the tubes very quickly because people could push a button on their iPhone and take their deposits out of the bank. And meanwhile, they had their assets, even if they were treasury securities that were long duration. They thought they were, AAA, 7 years, 10 years, whatever it was. But when you are forced to sell assets, on demand or, before you want to or when you have to, you're going to take a big hit before those, to sell those assets. And that represents big losses. And the combination of the two was deadly at Silicon Valley Bank, just like it was deadly at Bear Stearns and Lehman Brothers and Merrill Lynch and all the rest of them back in 2008. So I think what Athene and Apollo believe is that, their annuities are 7 years and their assets are 7 years. So, they have 7-year debt that they've invested in, senior secured debt or mostly, and the annuities are 7 years. So, no one could, there are penalties if you try to terminate the annuity early, and they originate a lot of private credit that they're uh, buying, they're investing in, so they cut out sort of the fee-taking middlemen. So they think they've created something special. In the last few weeks, their stock's gotten hammered as interest rates have risen rapidly, and so there's some concern both on the private equity and the private credit side. So their market cap, which was about 100 billion, is now closer to 70. Yeah, it's a big hit that they took. But they're not alone. Blackstone, KKR, Carlyle, TBG, they all took hits, in this very volatile, self-inflicted wound that's occurred here.
But you think they'll be fine? They're like the masters of the universe.
Well, I think that's a very big question because they really haven't been tested yet. They're a relatively new phenomenon. They started appearing, Athene was started right after the 2008 financial crisis. And so, and then it went public and then was bought in 2021. And so, has it been, been tested? It's been 4 years as part of 3+ years as part of Apollo. I don't think there's been a test. This might be a test. There's, some concern that, if regulations change or interest rates, go up rapidly, could be a problem, but I think they're pretty confident that they've created something that is certainly less dangerous than depository institution. And so, where the deposits can just leave immediately and the assets are long term. I think it's a phenomenon. Market was going crazy for it, loving it. Investors were loving it, and it's really not been tested yet. And the last week or so, there's been a little test, and the stocks have come down quite a bit, a shocking amount, frankly. But I don't think there's any near-term risk of a meltdown like we saw with Bear Stearns and Lehman Brothers and others in 2008.
My friend who's done a lot of research on this says it's the big problem with Athene and these other private equity insurers is what they call the Bermuda Triangle. So they create these offshore reinsurance companies in Bermuda so that if we look at, I don't know, I'll say a conservative company like GBU or, I don't know, Lafayette Life or Mass Mutual, you can look at their books and you can see what they own and how many treasuries they have and this. But the level of opacity, you can't really see what these private equity owned insurance companies are actually doing with their money. So you could see, okay, why Silicon Valley Bank went under is because they did this, they bought one duration. Then when the interest, but generally in insurance companies, they're supposed to buy treasuries, hold on to them for a long time, hold on to the debt for a long time. And then you could see, okay, their credit quality is A++ or A+, like a mutual insurer, or even a stock insurer, you can kind of see what they're doing. With these private equity insurers, because they're doing everything in Bermuda, you don't have that level of clarity and transparency. So he's worried that they're doing things that are probably a little bit more risky with those monies, similar. And I don't know if he's right. And in some ways, it looks like it was a good deal the last, 15, 16, 17 years. Security benefits done well. There's been a lot of them owned by private equity. But he's always worried that this will be the next, thing to go under. So I didn't know with your background if you.
Well, I would just say that, if your friend wants to see what they're up to, there's actually quite a bit of information because, the Athene itself, the insurance company, is based in Iowa. And so there are statutory filings that they have to make, hundreds of boring pages that actually list pretty much all of the assets that they're invested in. So you can actually see what they're invested in. But what's clear too is they've got a lot of money invested in riskier debt instruments, not just senior secured. There's a lot of senior secured debt, but there's a lot of riskier, higher yielding debt too. It's a fine line that has to be walked, and so far they believe they're walking it. But if you talk to people at Apollo, of course they think this is like the greatest thing ever. If you talk to some of their competitors, they note the risk because Apollo has become a principal in this, not just an agent. In other words, a lot of this is on the Apollo balance sheet. And of course, Athene is part of Apollo. And if you talk to people like I have who are sort of watchdogs in the industry, they are concerned. They are concerned because of what they see as the relatively some of the risky assets that they think risky. I mean, there's a lot of degrees of risk. So, just because you use the word risky doesn't mean that, the house of cards is going to come down. But, obviously, the higher you go on the risk scale, the more reward you get. But there are, the risk of default is higher. And so, but again, I think, we've been in a relatively benign interest rate environment for, since 2009, since certainly to 2022, when we were in a zero interest rate environment, and interest rates have gone up since then, both the Fed level and, in the market levels, long-term debt levels. So, there are risks, and regulatory regimes can change, regulatory requirements can change, and Athene could get caught in a trap like that. There certainly have been insurance companies defaults and liquidations in the last year or two, so it's not something that doesn't happen. It does happen, and so it's important to be aware. It's not all of which is to say there's this, like, again, before the last week or so, there was this euphoria about Apollo and Brookfield, and
Brookfield bought American Equity. Aris bought Aspida or formed it. Well, and Bain just today announced a 10% stake in Lincoln, I believe.
well, 10% stake is different. That's like an investment as opposed to, Athene is Apollo and Athene, or Brookfield and they're together, right? They're one. And Apollo's even because Brookfield sort of is like a holding company that owns a number of different businesses, whether it's infrastructure or real estate or insurance. And they also own, a distressed debt firm, Howard Marks's firm. So Apollo, though, is all in on this. They're quite integrated. It's the vision of Mark Rowan. It's proved to be extremely lucrative and sort of a bonanza in the stock market until this past week. And I think once this settles out, if it does settle out, that's a big if. We don't know yet. If it does settle out, then I think Apollo will resume its upward trajectory. But that means still the jury is out on whether this new paradigm, that this sort of marriage between private equity and private credit, the now dubbed alternative asset managers, is got the same kind of flaws that the depository, the investment banks and the commercial banks of the past, because of their structure, has really caused various financial crises over the centuries. Whether there's actually a new paradigm in place now that's less risky and safer. The jury is definitely still out on that. Although, clearly the Apollo principals feel like they've created something new and built a better mousetrap. So we'll have to see.
Yeah, my two friends are industry watchdogs. So Tom Gober is former forensic accountant auditor. Are you familiar with him?
I've talked to Tom. Tom is worried about this.
Yeah. And he seems like he knows what he's talking about. I mean,
he definitely seems to know what he's talking about. And what he told me is in the book, and it's in there, and he's approved what I wrote about him, and because I want to make sure I got it right.
I critique him too. I don't totally buy into what he's saying, because private equity can be an instrument of good in these companies, but I think he's just saying, well, I don't know what they're investing in. He has this ratio. He calls it the TSR ratio.
Yeah. He's a smart guy and seems like high integrity.
So you think there's some truth to what he's saying that you're worried about?
I do, because I've heard it from competitors who I also have a lot of respect for.
The only reason why I challenge it sometimes is, well, who's paying Gober now? Or who's paying these people? Because if I'm a mutual insurer.
Well, my sense is Gober is a sort of in the expert witness camp.
Yes. Yeah. So I think he's just looking at the numbers. Yeah.
Look, he can at least, unlike 99.999% of the people in the world, he can actually look at these statutory filings and make sense of them.
Exactly. Yeah. But I remember talking to him about, because I'll go to him and I'll ask him about, basically every new company he doesn't like, every private equity company, like, who would you trust? And, he does tell you, he ranks them. But what I got is, it's really the thing he doesn't like is the level that he can't see what they're doing. He can't look under the hood as a former regulator, auditor, but I always tell him and his other friend, Barry, they could be doing good, with the things under the hood that you can't see, and just be doing it for less fees and less regulatory oversight. It could end up being a win, right?
Yeah, I mean, Apollo-Athene is not the cheapest out there, but they're the biggest at this point, and probably the savviest investors, and probably the best originators of private credit. It's a pretty compelling package if you're somebody who's interested in annuities and preparing for retirement. I mean, yeah, I've spent a lot of time obviously talking to Mark Rowan, who's the CEO of Apollo, who I've known for a very long time and is a very smart guy. And one thing he said to me that really stuck with me, in terms of writing this book and just about human nature, is that, and this is so interesting because it's one of the flaws of the fractional banking system, and borrowing short and lending long, which gets banks in trouble all the time, And that is, I think we as humans feel that we don't feel comfortable and safe unless we can get our money out, right away. Like that's why if you put it in the bank, then you go to the ATM machine, you can put your card in, you can push some buttons, and you can get your cash, or you can do that all day long if you want and get your cash out. And if you have the app on your phone, you can push that around and take out a withdrawal. I think the point that the people at Athene make, which is pretty interesting, is in truth, we don't really need our cash on demand, and so we're foregoing a fairly meaningful return on that cash. Like if I have cash in my JP Morgan account, and I get 1 basis point a year. That's what they pay me. 0.01% a year.
Well, we got to talk about that. If you're a client of ours, you get like 4.04.
Right. And if I put my money at Marcus at Goldman Sachs, I get about 4. And if you get an annuity, I don't know what it is. I don't know whether it's 4 or 5.
The yields now on a 10-year, like they sell, to be fair, I talked about the negatives. By the way, I noticed, the yields, the 10-year yields now on the indexing type, it's like 6 to 7 over a 10-year historical, not guaranteed, but your principal is protected. No, they have a compelling story for sure. Yeah.
What it says to me is like, if JP Morgan Chase is paying you 1 basis point on your checking account and 2 basis points on your savings, and Goldman Sachs Marcus is paying you 4%, that to me is a very simple statement that's being made, which is JP Morgan Chase doesn't want your deposits, doesn't care about your deposits, would prefer if you didn't put your money in the bank with them. Goldman Sachs wants your money, wants your deposits. People who want things are willing to pay for them. People who don't want things aren't willing to pay for them. So why do I keep my money at JP Morgan Chase in that scenario? I keep some of it there because it's, inertia is a very powerful force. And it's just, I've done that for 40 years and it's just easier at this point. But I also put money at Marcus because I can see that they want it and are willing to pay me for it. And that's, by the way, Marcus is, I basically can still get my money immediately and I get roughly 4%. So if I had an annuity or, a 7-year annuity or something, I don't know what that would pay. But, if I'm willing to lock up my money for that period of time, and literally not get it, but get the interest, then I'm going to get a much higher reward. This feeling that you got to have your fingers on your cash at all time, that is really actually a very dangerous concept financially, because that's why Silicon Valley Bank went down the tubes. The people at Silicon Valley Bank, who had a very glam kind of reputation for a while, those people who put their money there were trigger happy. They took their money out at the first sign of trouble. Meanwhile, the irony is that Silicon Valley Bank the assets were invested in long-term treasuries, which, I'm sure they thought was the safest thing they could possibly invest in. And they are the safest thing you can possibly invest in. But that goes to the whole problem of the structure of fractional banking. I mean, it is so flawed. It is fundamentally flawed by design. And we live with it because it really kind of blows up once every 20 years, and the rest of the time is fine. As long as everybody doesn't want their money at the same time, it's always going to be fine, because you put your money in the bank and there's this fiction that your money is at the bank. But of course, your money's not at the bank. It never was at the bank. If it were at the bank couldn't make any money off it. So what, like JP Morgan does, why is JP Morgan making 52 billion of net income a year? And I didn't even see what they did today in terms of their first quarter net income. I'm sure it's on track to do even more than 52 billion. even in these rough markets, because they're getting their raw material for free. They're paying me 1 basis point for my money, and they're what, 2+ almost 3 trillion of deposits. They're paying nothing for them. That is their raw material. What other business on the face of the earth pays nothing for their raw material? They pay nothing for their raw material, and then they lend it out at big spreads. And so if you look at their interest income line, it's gargantuan. Of course it is, because they're paying nothing for their raw material, and they're lending it out and investing it or whatever the heck they do with it, and they're making huge profits on that. They don't want my deposits because they're not paying anything for them, but they get them anyway. Some great business.
Yeah, fantastic business. Let's go. Let's get a bank together. Let's go buy a bank. Get some money. I'll do it.
That's true. I mean, it's a great business, banking.
It's a better business, by the way, than the annuity business, because the annuity company has to have 100% reserves for those annuity deposits. So it's a totally different business model. But yeah, I'd rather own a bank than an insurance company for sure. So I want to be clear. I am in no way equating Silicon Valley Bank with Athene, but we got into Athene and annuities and banking because of the new book coming out next year, which I want to buy, and I'm sure you all will want to buy, called Apollo Unbound. Kind of a behind the scenes look at Leon Black and Apollo and Athene are kind of synonymous. So I said, hey, is that risky? What I was talking about is sort of like an archaic debate in the insurance industry between people who say they want more transparency. But even still, there will not be a Silicon Valley type experience with Athene. My question is the quality of the debt. What are they buying? Are they taking a little too much risk with retiree money? So I would say they're very different things, but just was curious on your take on there. Any thoughts on the recent bond market sell-off? That kind of makes me worried more than the stock selling off. Do you worry about that?
I totally agree with you there, for a number of reasons. People who invest in the stock market, that by definition is risky. I mean, you know that it's money that is under no obligation to be paid back. Right? You invest it, you could lose it, and you've got no claim. Equity holders in a bankruptcy can make a fuss, and if they're represented by, I remember on several occasions when I was a bankruptcy banker at Lazard, being opposite Wilbur Ross, who became Commerce Secretary, and Trump won, and he was really gifted, and he would often represent the equity holders in bankruptcies where I was involved, and he managed to pick the pocket of the debtor and always get a return for the equity holders. It was a beautiful thing to watch, although I was on the opposite side of him. But normally, equity holders, get wiped out. Creditors, of course, have contractual obligation to be paid both interest and the principal back. So, you know, when the bond market, you would think after, and this did happen for a day, when Trump announced his, excuse me, I think they're crazy tariffs. They have no basis in fact or theory, whatever it is that he's believes. But he's the president, and he can do this apparently pretty much on his own and get everybody to try to believe that he's doing the right thing. So, and the stock market's tanked. There was a flight to quality. The 10-year was at around 4% when he started this insanity, and then went down to like 3.885%. So yields came down, price of the bond went up, so the bond market rallied, and then since then, when the reality kicked in about what he's doing and how nuts it all is, bond investors just said, I'm out of here, and they fled, and the yields are now at 4.5%. I mean, a major move up in a very short period of time. And, that's got implications for lots of things, for corporate borrowings, for mortgage rates, for car rates, for annuities, for all these things that are more or less tied to the 10-year treasury. But the bigger problem always is, and I've watched this many times, and it's when credit just dries up and there's a credit freeze or a credit crunch, and credit just isn't available, at any price except for, the best borrowers, and then they probably have to pay more. Spreads have widened out. Spreads were at historically low levels until this tariff palooza, as I call it, started. And now if you look in the high yield market, which I love to look at the high yield market uh, for what it tells you about people's uh, uh, feelings about risk, and how their feelings about risk are changing and how much risk they're willing to take. I mean, the yields in the high yield market shot up to 8.5% from around 7.5% before this. I mean, another huge move. We saw a similar kind of huge move back in February and March of 2020 as the pandemic was rolling out. That resulted in an even bigger spike upward to like 11.5% on the average yield on a junk bond. But this is a pretty big move and beginning to be quite worrisome. I noticed the Fed today is saying they'll step in if they have to. Well, they had to in 2020, they had to in 2008. And, frankly, if they have to again, it's pretty damn embarrassing, especially since this is a totally self inflicted wound and doesn't have to be this way. And who knows what it's accomplishing or why. But these bond yields have spiked up, and that's the signal that people are getting very nervous about credit. And when investors are nervous about credit and are demanding higher yields, then issuers are basically begin to get locked out of the market. If issuers can't issue debt, then we have a credit freeze and credit crunch, and it's a virtual guarantee of a recession. So we're on the precipice now of that, unless our master in chief decides to reverse course on this lunatic binge he's on.
Didn't he kind of reverse course this week, though? The 90-day pause?
I mean, I think people initially thought that he was reversing course or doing something. He said he would never do the pause. Then and all of his surrogates said he'd never do the pause. Then he does the pause. Markets, exploded, of course, upward. And then, on Thursday, gave most of that back, and bond yields went up again. And so I think, and he's saying, we're putting 145% tariffs on our third largest trading partner. So, I don't know. It's all such a cockamamie uh, approach. You know, again, people think there may be some validity to what he's trying to do in the long run. I don't buy this personally. I think our trading relationships are just fine. The wealth of this country has increased dramatically. People have lost manufacturing jobs. Yes, that's true. But do people want those jobs? Even if that all came back in 10 years, are there going to be people who want to make vacuum cleaners? I don't know. We are a service oriented economy. The Economist magazine last October said that our economy was the envy of the world, and certainly not anymore. So maybe there's something to trying to bring manufacturing back. That is a 10-year thought process and analysis of cash flows and internal rates of return and return on capital and return on equity and all those sort of Wall Street finance terminologies. That's not happening anytime soon. What is happening soon is that what you buy at Walmart, since 80% of it is, imported from China and elsewhere in the Far East, is going to go up dramatically relatively soon, much sooner, of course, than a new manufacturing plant is going to be built in the Midwest or anywhere else. So, if he feels so strongly about these tariffs, he's made it the number one global issue. Like he also said the other day that we got to allow. It's like a Seinfeld episode. We got to allow for more flow on the shower heads. Okay, and he deported a guy to El Salvador prison who should not have been deported. I mean, there's so many things that are going on that he's doing that aren't getting the attention of these tariffs because he's made it this global issue. He's raised it to like the most important issue of the day. And if this is something he feels strongly about, he would have been much better served to sort of have unilateral discussions in conference rooms that are boring and don't get any headlines or attention that kind of happen all the time, these trade negotiations, and cut deals with these people and do it quietly and not upset both the bond market and the stock market and everybody's confidence in them.
The bond market worries me.
Totally. That's where the big worry is. That's why everyone's going crazy now.
The market's good until things break. And I don't, we have that oh crap moment. That's what worries me about this. Now, on the tariff side, and we're going to get to your research in AI. You've done a lot of study in Wall Street and AI. Here's what I'm thinking. AI was at a conference, Llama 4. Are you a big student of AI?
I'm a little student of AI. I don't like that AI hoovers up my content for free without my permission or compensation. But other than
that. But
in
a service economy, like you mentioned, we're predominantly service. And I agree. My point is, who wants these factory jobs? Nobody. But in 5 or 10 years, when AI replaces 90% of the service economy, those people are going to need jobs.
And what about the robots that Elon is going to deploy in all these manufacturing plants? So we're all going to be farmers.
Yeah, bring back Make America Farm again. But how do you think, let's talk about AI for a little bit. We're going to talk about retirement. I don't know. I mean, I do think there is a valid point of bringing manufacturing, especially with what happened with COVID and supply chain shortages and all that. I think there's a benefit to bringing manufacturing. Also, if you read Art of the Deal,
which he didn't write.
I know, but he kind of, it takes some unreasonable position that causes people, which happened. Markets crash. Now he's basically caving and is going to negotiate fair deals, and he'll be lauded a hero in 90 days. I mean, except the China thing. The China thing worries me because you can't, like 150% or whatever, 125% tariff.
45.
Sounds ridiculous.
Yeah, they've been around 5,000 years. They take a long-term view.
That they're going to do fine without us.
They don't pick fights. I mean, they don't start wars.
If you've studied Chinese history, they think where we think quarter by quarter, they think 100-year plan. Everything we have, they have. But there is some truth to how they knock us off on trade deals. And I think the bigger offense to China in trade is more the intellectual property abuses. Now, I don't know if the tariffs are really the issue. It's more of the, you have somebody who manufactures something in China.
Why does Apple manufacture iPhones in China?
Cheaper to manufacture them there.
Because it's cheaper. They have more people. They'll work for less wages. Their costs are lower. And they send the phone over here when it's done, or we finish it here, whatever it happens. And they sell it for whatever, $750 or $1,000, whatever it is. We changed all of our lives. And if it were made here, it would be $5,000. How are we disadvantaged by that? Is our pocket being picked? Are they taking advantage of us? Apple is entering into this willingly. China is entering into this willingly, and consumers are buying it willingly. I have a trade deficit with my barber.
Oh, I was going to bring up the barber. Yeah. Go with the barber example. That's a great example. I'm against tariffs. I'm a big opponent of tariffs, but bring this up because this is something people don't think about. And the barber analogy, I've heard this before. I got an email on this from a buddy of mine, and I think you're going to go there. So go there with the barber analogy.
Barber analogy is I still have some hair on the top of my head, so I have to go to the barber once a month, and I pay him whatever I pay him. He cuts my hair. He buys nothing from me, nothing every month. So I have this like trade deficit with my barber. Is he taking advantage of me? No. I'm entering into the transaction willingly. He's entering into it willingly. I'm giving him pieces of paper that have numbers on them. He's giving me a haircut. I mean, is that something that we need to tax at 145% now because he's taking, I've got a trade deficit with him? No, it's absurd.
Yeah. And now Tony the barber is going to charge you $60 instead of $40 because he has to pay the tariff. So I'm a total, no tariff person. However, I do think there is a point to reciprocal trade. And if we could have, for example, Elon called for a free trade zone with the Eurozone, they should not be tariffing us and we should not be tariffing them. I think if these deals and Trump's tough talk can get us deals like that, that would be a pro of all this and send the stock market soaring, wouldn't it? If something doesn't break. See, that's what worries me. The bond market is signaling is something breaking. And people with money are like, I'm out. And that's what happens when you have a 2007 to 2009 stock crash.
Trouble, Will Robinson. Danger, Will Robinson.
Do you think there's anything that can be done to avoid a danger, Will Robinson moment? Or is it too late?
Well, with someone who was probably less narcissistic, less suffering from some sort of narcissistic disorder, somebody who was willing to concede that he may have made a mistake or got bad advice.
To be fair, didn't he, though, with the 90-day pause?
I don't think he is.
This is my take on this week. I'm going to be a little more favorable of him than you are. But if you look at Monday, right, the markets nosedived because it appeared that Trump was siding with Navarro, the Navarro kind of thesis. Wednesday, markets rallied because the 90-day pause. He seems to be siding more with the Musk contingent.
Bill Ackman, Scott Bessent.
Yeah, but it seems like he's listening. I mean,
have you watched Scott Bessent talk about the tariffs on TV? Scott Bessent, who's supposed to be the great white hope inside the Trump administration, who is familiar with the bond market, George Soros, Druckenmiller,
yeah, that crowd.
Yeah. So, if he is what we're supposed to put our faith in, I think we're in big trouble because I don't think he believes in these tariffs, and he can see the effect that they're having, and he's being sent out to justify them and articulate a reason why it's the greatest word in the English language, and he clearly doesn't believe it, and so he can't defend a policy that he knows is fatally flawed, and yet he's being sent out to do it. And so what does he do on national TV? He just dissembles. He can't look at the camera. He can't look at the anchor. He just sits there and, tries to defend something that's indefensible because he knows that he got the job because he said he would defend them. And now he's seeing what the effects are. And he probably could have foretold what the effects were going to be. And now he can't articulate why we should be okay with this and why it's like the art of the deal and the genius of Donald Trump. I think we have a fatally flawed strategy from the outset. It's being implemented in a ham-handed way, to put it mildly, and we're dealing with the effects. Now, there's a lot of hope if somehow this guy could say, okay, my bad, or I mean, maybe he can blame it on some other people if that makes him feel better and just reverse course. If he just says, look, we're going to do what I suggested, which is go to the boring conference room with the dim lights and the green eye shaded, accountants and negotiators, and figure out some interactive trade deal that makes sense on a bilateral basis, and not make a big deal out about it, but just get it done quietly but effectively over the next 3 to 6 months, then the markets would soar and people would feel great again.
I firmly believe Elon Musk just sticking it to Navarro in the media Monday, Tuesday caused Trump to pivot. I really believe he's going to pivot. We're going to get really good deals. Maybe I'm an optimist, but I could see the only thing that worries me is this bond market breaking and credit drying up. That to me is the systemic risk. And did the tariffs cause people to just say, I'm done? I'm just going to park my money in cash and ride it out. But I will tell you what's positive is I would argue that no one would do those deals, meaning Europe would not agree to a free trade zone and free trade if Trump didn't do this more bombastic stance. I mean, nobody's doing those private deals unless he does this.
Unless people think he's a madman?
Yes, I do think there's some truth to that status, but we'll see.
Well, you know what? We'll see. That's the current thesis.
We both agree that tariffs are bad. I just think there is more to this than just one argument. So let's talk about retirement and then AI. How do you think the current market is going to impact people's ability to retire comfortably in the coming years? Do you worry about that?
I mean, anytime the bond market starts to crack, the equity markets, retrace levels from several years ago, and confidence is lost in our financial markets, which clearly is happening. Confidence is lost in the executive branch of our government, which clearly is happening. There was a lot of hope put in this, Trump too. I mean, a lot of people put a lot of hope in that he would deregulate, that markets, would boom, and that Wall Street would boom, and blah blah blah. Far be it from me to judge that faith. I personally didn't see it, but whatever. I'm a New Yorker. I've seen the Donald before he was president. I lived through Trump 1, and I'm not surprised by anything I've seen so far in Trump 2. But I think it's the juxtaposition, frankly, of the optimism that a lot of people were feeling with his second inauguration, with the absolute narcissism and buffoonery that's taken place since then. And the markets are just reacting to that loss of confidence, and markets are a confidence game. Financial markets are a confidence game. And I mean that in in a positive sense. And when that confidence is lost, it's very, very hard to get it back. Comes back, obviously, because confidence is lost on average once every 20 years. We have a financial crisis or some sort of hiccup, and the confidence comes back. This is clearly driven by one man and one man's vision, which he believes he was elected to implement by 75 million Americans, and a resounding electoral college victory. And I see where he comes to believe that. I think he's completely wrong, and I think you do too.
Yeah, I didn't vote for tariffs. I don't see that. And probably half of the people that voted for him don't like tariffs.
Well, at least that's one thing that he was talking about during the campaign, unlike, going after law firms and letting criminals out of jail.
Let's talk good news. Good news came out. Doge actually was successful, apparently. The Treasury Department published its monthly Treasury statements, and the March spending is the lowest since 2022. So the 528 billion spent in March 25 is almost down to the 507 billion spent in March 2022. So we got a 3-year going back in time and spending a lot less. I don't know if you saw that. That's good news, but I don't think that's being, talked about. Did you hear about that or no?
I saw something that Musk said that.
No, I don't mean Musk. I try to just look at the facts. So there's actually final proof that whatever's happening, whatever Musk did is apparently working a little bit. Hey, I think if the tariff tantrum is over, I think we probably have Musk to thank for just ripping Peter Navarro a new one.
Yeah, a big if. Yes, I mean, or Bessent going down to Mar-a-Lago and riding back on the Air Force One to Washington with Trump and trying to talk sense to him about what was happening in the bond market.
I think the bond market is signaling, hey, this could be another 07-09 crash, and wake up, or else you're going to be like George Bush in 2007-8. I think that's a very clear sign the market was sending the last few weeks. Hopefully he took it.
07-08 was a seriously systemic situation based on the architecture and the flaws in the architecture of the financial system. Borrowing short and lending long in a fractional banking system is a fatal design flaw. Always has been, always will be. It's less of an issue now because of Dodd-Frank and that risk that was in the investment banks and the money center banks has moved out into, the Apollos of the world and the Ares of the world, KKR and Brookfield, et cetera. So this is not that.
But this is a bigger risk. So financial firms, my firm, I get quotes. We'll give you 12x. Mergers and acquisition activity by private equity. They're giving people with my size firm 11x, 12x on their money to buy their financial firms. Where are they getting the money for that? They're getting the money from the Apollos, the KKRs, and then they have these small firms. And if you look at the nexus, this kind of
what is KKR and Apollo likes to say that whatever 80% of what they lend is senior secured. So
I don't know. I hope you're right. I'm just saying.
Well, that's what they say, and our friend who looks through the statutory filings could give us the answer. What percentage?
Yeah, he
is.
knows more than that than I do.
He knows.
No, but I'm not just saying insurance companies. I'm saying in every area of life. Okay, we talked about insurance, which is probably stronger than most private equity activity. Private equity buys Toys R Us. Private equity buys Brooks Brothers. Private equity is buying financial advisory firms. Private equity is buying plumbing and heating. What I'm saying is this everything bubble is just predicated upon, they borrow cheap money. They give founders 12x, 11x.
I think what you're talking about, the 11x, 12x EBITDA, that's changing pretty rapidly. Buyers are not willing to pay that anymore because they can't borrow to sustain that level. And I mean, M&A activity is way down. Private equity dry powder is huge. And a lot of investors in private equity are getting frustrated because they're not getting their cash back. And what's happening that is disturbing, or was happening, I don't know how much of it is still happening after the last few weeks, but to get investors a return on their money, the management companies of these private equity firms are borrowing money from banks and paying that money out as a dividend to limited partners who are frustrated that they're not getting their money back, or the portfolio companies of the private equity firms are being levered up to pay a dividend to the limited partners because the M&A market part of this is not functioning well, or the IPO market is not functioning well. And now we're right back at that again because of the events of the last few weeks. So, by the way, look, I mean, Apollo has what, 700 billion assets under management. 600 billion of it now is private credit, and growing like a weed. Private equity is a nice business. Believe me, it's a great business. It's, can make more money legally, however you define that, than almost any business on the face of the earth. It's such a great business. You borrow money from somebody else, you get the tax deductibility of the interest, you pay down the debt from the cash flow of the companies, and you increase the equity value, and the private equity firm gets 20% of that plus fees. I mean, what a great business, but it's not a growth business. And like the Apollos of the world and the KKRs of the world and the Blackstones of the world are predicated on the growth side of their business, which is the private credit side of the business. And that's growing fast. And again, as we talked about before, the jury's out on whether that's safe, profitable growth, or we've created another time bomb.
Yeah, well, we shall see. So let's talk AI. You wrote a piece called The Investment Banking in the Age of AI. I've seen some of these AI stuff lately, and it's crazy what it's doing. What worries you about AI in investment banking? What do you see as the positives?
Wall Street loves the shiny new object. AI is the shiny new object, or again, before the last week or so. I mean, the whole mindset is just completely changed. I hope people really fully appreciate that, who are listening, or may listen to this. I mean, the mindset is just completely changed. So anyway, before this, AI was the shiny new object. Elon Musk, in the dead of the night, a couple of Fridays ago, I think 2 Fridays ago, in fact, announced that he was, rescuing Twitter X by merging it with XAI, his AI company, which had a $80 billion valuation. And so now, XAI Twitter is got a market valuation on paper of 125 billion, and 13 billion of which is debt. So now all of a sudden the equity is, exploded when the equity really was wiped out for X alone, and probably should be. So, so AI is a great kind of thing to, create an investment banking bubble about. And there's all sorts of investment banking potential fees related to AI. So on the one hand, that's why Wall Street was loving it, because it's like, the internet 1.0, or whatever other, or SPACs, or whatever the current fad is on Wall Street. That's what AI is. And they're just like feeding that beast, and everybody's, getting fat and happy from that, or was before a week ago. Then there's the issue of AI replacing jobs on Wall Street, or enhancing jobs on Wall Street. I wrote a piece about a company on Wall Street that provides investment banking services to AI investment banking services to Wall Street firms, and using AI to provide some of the number crunching that junior analysts and associates provided. And so there's concern that those jobs might be lost. I don't think that's an issue. I think, frankly, it just sort of allows them to do their job more quickly, because they can have AI crunch the numbers and fill out the tables and do the comps and the this and the that more quickly. That would take these poor analysts 20 hours a day for 10 days. Now it can be done by AI in a couple of hours, but then you got to check it. But of course you have to check the analyst's work too. So I think that AI on Wall Street as a product is going to I think help bankers do their jobs better and more efficiently. May result in some job losses, but not a meaningful amount more than would be lost anyway from poor performers or whatever it is. I'm now a full-time writer, obviously. Yeah, I don't use AI. What I do, is bespoke. When the robot can go out and interview Leon Black for 2 hours at a time, 10 times, and synthesize the information that he shares and turn it into a narrative. That's when I'm going to be worried. I'm not really worried about AI going and interviewing Leon Black. What I find is, of course, when you Google something now, Google's AI, spits out its answer at the top of the stream now, and it used to never do that. And so, I mean, is that useful? I guess that's a little bit useful. I mean, you have to check that and think about it. You can't just like take it as gospel. So, I mean, I'm not particularly worried about AI. I mean, my friend Scott Galloway says that AI is not going to replace you. The person who is good at using AI is going to replace you, and I think there's something to that.
But how many people work for you at Puck? If Puck counts, how many journalists? Are you the sole journalist or are there junior journalists?
No, we have about I think there's 10 or 12 of us.
Here's what worries me about AI. You're the founding partner. You get a couple other founders. So now you have 12 people. And by the way, March 2025 was a major tipping point in these language models of AI, where before it was just dumb. I hated AI. Like I would do it and clunk around and I'd be like, this is a waste of my time to do AI. You could actually now program your brain, all of your works, all of you in print, in writing, in communication. You feed it to your AI bot that you have a programmer do. Boom. And you could probably get rid of like 10 journalists. So you would still be necessary. There would still need to be a senior, partner in there to make sure everything's, but maybe instead of having 12 people, you have 2 or 3. That's where I think it'll be a vast displacement of labor. And I'm worried about job losses in that. So I don't think it's replacing the people at the top. I think it's really replacing a lot of the entry level. So programming, for example, I was talking to a big AI guy this week. I said, what do you need to build? How many employees? He said, I need 4. I need 4 senior level AI programmers because they can now replace a lot of the work of the junior programmers. So I think that's where it worries me is the displacement of labor and, more job loss and all that type of stuff. But I actually like what I've seen the last 30 days because you can feed the AI all of your literature, all of your books, and out pops a bot that sounds like you. So you can say, write in the style of William Cohan, a best-selling book. And then you feed it the data. And over time, the book will sound like you and your voice.
Nah, I'm not buying that. I know people are trying to sell that. I'm not buying that.
I wasn't buying it either until I saw it the last 30 days. But
okay. Look, I've seen what it can spit out in terms of investment banking analyst, spreadsheets and PowerPoint presentations that are pretty impressive and spits it out a lot more quickly and distills information down that, instead of like getting the public documents from the SEC about, Oracle and then writing that all out on spreadsheet, on PowerPoints, that has to be done every single time. You just ask the AI to do it and it does it and it spits it out, and then you got to go through and check it all and make sure it's right. I mean, I don't know who wants to do that job, but okay, that could save some time. But journalism, I mean, journalism isn't just writing in the style of Bill Cohen. It's, going out and talking to people and getting the story and reporting the story and bringing it back and writing it up. And one thing that AI does that, I wrote an op-ed in the Washington Post probably more than a year ago now about how I found it incredibly irritating that AI, these LLMs, were hoovering up my books and my bespoke content without my permission and without compensating me. That feels like thievery to me, and a violation of my sanctity and of my intellectual property and what I've worked my whole life to produce. And that doesn't feel right to me. And so when, you know, Microsoft through OpenAI, Microsoft's a $3 trillion company, plenty of resources, they could absolutely have asked me and cut a deal with me, and I would have probably been happy to do it. But to steal it from me without permission, without asking, and hoover it up, I think that's disgraceful. But what am I going to do? Go after Microsoft?
Let's do it. Let's do it. I think that's horrible. I mean, no, one of my books, I had a bestseller and I got contacted by the publisher. Oh, we want to give you $2,500 to have your book into AI. I'm like, no, I'm not doing that. $2,500, it's nothing.
Well, that's better than nothing. And at least they asked you. Well, I got nothing for 7 books.
Well, now I think the publishers are cutting deals now, but I don't know. I think it's wrong. I think the intellectual property, I think there's going to be some reckoning there, but it's tough because it's hard to, they say, oh, it's a matter of the public domain and all this other crap. But yeah.
It's not in the public. It's my intellectual capital.
So is there anything being done on that or no?
There are some lawsuits, yes. There's some, the New York Times is, of course, leading a lawsuit on this, and some authors are as well. But, lawsuits take a lot of time and are expensive. You really want to get into a lawsuit with Microsoft?
Yeah, it's like David versus Goliath.
Totally. I mean, they'll probably win, but how much is it going to cost?
What's going to happen, which will really tick me off, is there'll be some dumb like class action settlement. So you will get like $5. If you're an author, you'll get $5 as a part of an $80 billion settlement that the attorneys won and the lead, class action person. Anything you'd like to plug for our audience before you leave today?
I would encourage people to, think about my books. I have a website, williamcohan.com, which lists my books and a bunch of my articles. And I encourage people to, subscribe to Puck, because I think it's a unique product it's a journalism company owned by journalists. There aren't many examples of that. And so we've compiled a group of great writers who are experts in their fields, like I am in Wall Street or Washington or Hollywood or art or fashion or law. So I would encourage people to look up Puck.
Yeah, Google Puck. Also, be sure to get his books, Money and Power, House of Cards, and The Last Tycoons. And thank you so much for joining us, William. Any concluding thoughts for our listeners, things you wanted to share that didn't get a chance to share?
Please write your senators and congressmen and get them to take back the power that they ceded to the executive branch on tariffs. And if you have any way to convince Donald Trump to rethink this cockamamie policy that he's endeavoring to implement, I think we'll all be a lot better off when he abandons this idea.
William Cohan, thank you so much for joining us. And I hope to have you on soon to talk about Apollo Unbound.
Thank you.
It's a lot of fun. Thank you all for joining us on X. Be sure to follow William Cohan at William Cohan and follow me at Your Financial QB for more exciting X lives. I'm Josh Jelinski, the financial quarterback. Be sure to subscribe to my podcast as well. Thank you so much. Make it a great day.